Hello, everyone, and welcome to the live stream. I am Pooja from Prachay Group, and today we are going to discuss about Prachay Capital, the investment opportunities available, and how it can help you in your financial planning. So let's get started. Okay, so who we are, that is, who is Prachay Capital Limited? Prachay Capital is an RBI registered non banking finance company. Now, when I say non banking finance company, that means a company which cannot have normal banking operations but can finance companies or businesses. We cater to mid to large size businesses by providing them required capital or required funding. Now, how do we do that? When we deploy in two manners. One is corporate loans or corporate credit, and another one being by investing into corporate bonds of the businesses. Now, that is on the asset side. Majorly, NBFCs are more focused on the asset side of the business. But at Prachay, we maintain and balance between asset and liability side. On the liability side, we maintain and we provide investors with wealth management options through high yielding fixed income securities, that is, hi fi securities. Now, under this, we cater to HNIs, family offices, corporates, retail investors by providing them fixed income opportunities like non-convertible debentures or corporate bonds, which we'll look into further, and intercorporate deposits, that is ICDs, in which company lend from another company and pay them return. These are the two methods by which the company raises funds. Now let's understand investing. So every person who earns something have some part of it goes to saving, out of which investments are being made. When investments are made, a future goal is set, and accordingly, investment plans are being built. Your portfolio, or what all will your portfolio consist of, depends on your eventual financial goal. In investments, we see some people even make investment into real estate. That is, when they have a large chunk of money, they prefer making some investment into real estate. Another one being bullions, that is gold or silver. In India, or as Indians, we are very fond of buying gold at any festivities or on our birthdays or any special occasion. We keep buying gold maybe as a jewelry or as an investment. So that also forms part of your portfolio. Other than that, some of us also invest into equity markets or capital markets. Through this, we buy equity shares of different companies and build our portfolio. Or there are also options like mutual funds, through which you can invest into several companies through mutual fund entities. Another securities option, which is very unexplored, is debt. Now, what is debt? In debt, there are two things. One is bank fixed deposit. Bank's fixed deposit, we are quite aware of, maintaining an FD with the bank. But there's one more thing, that is corporate bonds. Corporate bonds is a way which is actually very unexplored, but it also provides balance to your portfolio. Now, what are corporate bonds? Corporate bonds are an instrument through which companies raise money from investors, pay them fixed and regular returns, and at the end of the tenure, they pay them the full principal amount. Now, what are benefits of corporate bonds? One is diversification. There is a thumb rule: 100 minus your age should be the amount you invest into equity and the balance into debt. It's very important that in your portfolio you maintain a proper diversification of equity and debt. By doing so, you balance your portfolio against risk and returns. Next, regular cash flows. Regular cash flows, that means for certain expenditures of yours, you need regular funds flowing in. Now, these kind of fixed income securities or corporate bonds provide you with fixed return, that too at a regular basis, maybe monthly or quarterly. But on the said period, you will be receiving a set amount. And it becomes very important when you want to have your investments afford your expenses, or you could just take care of expenses through your investment returns. That is when regular cash flows come into good picture. Next, low volatility. Now, why low volatility? Corporate bonds or prices of corporate bonds are not being hampered or do not are not volatile to market situations. Market fluctuations do not impact onto the status of the corporate bonds prices. Now, when I say low volatility, I mean low because the liquidity in the secondary market for corporate bonds is still not that developed. It is still under the development phase. So there might be a chances that you might not have a liquidity, but the prices are not going to be changed because of the market situations. Next, truly passive. As an average investor, we want that we invest our money and then we just relax back and let the money work for itself. Instead of going down to the market and just checking out what is the stock prices or how is a particular company performing, is it red, is it green? I don't want to have that headache all the time. Or I don't want to acquire any investing skills as such. In that cases, corporate bonds or fixed income securities play a very important role because you could just invest your money, and because they are not volatile, you don't have to go to the market to say if it's green or red. You will find your return in your bank account on a monthly basis. Fixed return. Sometimes for certain expenditure or future goals that we have, when I set a financial goal, in that case, you want on that particular day or on that particular date, such sum of amount is available in your bank account. Maybe thoda upar niche, but you still want that kind of a fund to be there available for you. In this case, corporate bonds or fixed income securities play a very vital role because they provide you with a fixed return, so you don't have to worry about the fluctuations at any given point of time. Now let's compare it with few of the investing opportunities that we look at. That is one bank FD and another one being equity. So bonds are technically in between of bank FDs and equity. Now how is that? Because bond provide you with fixed returns and they provide you a return type of equity that is on the higher side. On bank deposits where you can earn 5 to 7%, or in case of senior citizens which goes to up to 9%, under bonds you can actually earn 9 to 13% depending on the company. Next, on the type of return flow, normally in equity, it is very variable that when will you find your return or when will you get your returns or whether you will even get your returns or not. In bank FD, it is completely fixed. Either it's monthly, quarterly, or half yearly. Corporate bonds are the same way. Your returns are fixed. That is, you will know on what defined period you're going to get your returns. Normally, return periodicity in bank FDs and corporates are more or less the same, that is monthly, quarterly, or half yearly. But in equity, there is no such periodicity through which you're going to get your return. It is when you sell your investment, that is when you can get a real return in your hand. Now, under this corporate bonds, we bring an opportunity to you to invest into the public issue of Prachay bonds, which opens tomorrow, Friday, 28th February 2025. Now, what are we offering under these bonds? So, we are offering you with an interest of 13% per annum, which is fixed, and the interest payment will be done on monthly basis. The minimum investment value is very small, that is rupees 10,000. Now, why such a small investment value? Because we want that people explore this new avenue of investment, that is corporate bond, by making at least a small chunk of investment and to actually see how they work for you in your financial planning. The tenure of this bonds is 5 years. When I say 5 years, it does not mean lock in of 5 years. It just simply means that if you do not withdraw your investment within the span of 5 years, then after 5 years, you will automatically get your principal payment back, that is auto redemption. But you had an option during this 5 years, you could sell your investment into the secondary bond market. And also, to facilitate the same, we are coming up with our online bond platform to provide you with this liquidity option during the tenure of 5 years. Call option. Call option is nothing but a company's option if they want to redeem your debentures sooner than 5 years. So, for that, company can redeem your debentures anytime after 1 year. Secured investment. These investments are secured, that is 100% security. We provide 1x security cover on your investment. Also, we provide you with pari passu charge with our existing lenders. When I say pari passu, I mean my existing lenders and investors are on the same place or are on the same level when it comes to holding the collateral. Neither first nor second, all on the same stage. Another security is there is a SEBI registered debenture trustee being appointed which is Catalyst Trusteeship Limited, who monitors companies' operations and safeguards the interest of the investors to make sure company is functioning in the right manner so that investor money is safe. The credit rating for this bond is triple B minus stable by Crisil Ratings Limited. The reason for triple B minus is that our company's size or the bond size is so small that to have a rating above A or A grade rating, we need a bigger size of book to be rated that way. Also, the allotment is on first come, first serve basis. Now, what do I mean by first come, first serve? It simply means that whoever comes first to get the investment, those will be the people who will be allotted the entire amount of their investment at the end of closure of the issue. Now, why invest with us? There are so many opportunities in the market for bonds. Then why should you put your money with Prachay? The reason being, as I said, we are RBI registered NBFC. That means RBI regulates us and makes sure that our business is done in the rightful manner. Another one being, as we are going to be listed with BSE, that means we are going to be SEBI compliant. In short, two of the most important governing body of India, that is Reserve Bank of India and SEBI, will be regulating our operations and making note of the companies working. Plus, now that we'll be listed, our operations will be quite transparent. That is, you could check our quarterly financials on Money Control or even on SEBI or BSE website. Plus, company's board meeting, general meeting, or any kind of meeting done in the company, you will have an easy access to the minutes of those meetings, and you could see how is the company performing, what are the decisions being made, or how is every overall operations been going on. Now, with every investment, there are certain risks associated with it. Now, what are the risks associated with Prachay bonds and how is the management planning to mitigate these is as under. One is credit risk. As we are into the business of lending, there is always a risk that is credit risk or default risk. Now, to mitigate this, we provide 100% security cover to our investors. Also, all the loans provided by Prachay are fully secured and we take minimum 2x security cover on all of our lendings. That means our investor money, which is lended ahead, are secured and always have a reliability to be paid back. Next is liquidity risk. As I said, the secondary bond market is still under development. That means the liquidity is still not so available. But to mitigate this risk, the company is launching its own online bond platform where they will give you an option to sell your investment or even buy from the portal. Regulatory risk. If you are being regulated by RBI and SEBI, then following their norms become very mandatory. So in that case, there are chances of being a regulatory risk in case of any norms being violated. But as I said, we operate at the highest level of corporate governance, and our entire team consists of professionals, that is, chartered accountants, company secretaries, advocates, that helps that all of the norms laid down in under RBI and SEBI are completely followed in law and spirit. Now, how can Prachay bond be a part of your financial planning? Or how is it useful if you're making a financial plan for yourself? One is expense mapping, or you could say cash budgeting. Now, how that could be helpful to you. So, every person has certain expenditure which are fixed, which do not stop whether your income is generating or not. In that case, such kind of fixed income securities can help you to map your expenses to these returns. That is, say for example, any of your expenditure for a month, you could just make sure that this particular expenditure, say of 1,000 rupees, 2,000, 5,000, however the amount be, is being taken care by the returns you're generating from Prachay bonds. So make an investment to the tune that you get monthly return, which could take care of your expenses. Emergency fund generation or retirement funds. We all are well aware that emergency, like medical emergency or any other emergency, could knock your door any day. It come always uninformed. So to be safeguarded against these kind of things, you could make sure that you have fixed returns coming in so that in case of any kind of emergency, these fixed return can take care of the financial side of your emergency and you could be at peace emotionally with your family. Lifestyle expense planning. Everybody likes a little luxury in their life. After a tired full day, month, or a tired full quarter, you feel like taking a trip down somewhere, a long trip, or maybe just going out for shopping. So you could make sure that you plan your finances in a way that the returns that you're going to earn from your bonds investment, they could take care of these kind of trips. So you could invest and then see that your monthly return after 6 months, if you're planning for a trip and you have a budget of a lakh rupees, so you're earning a lakh in this 3 to 6 months, wherein you could have your luxury vacation without hampering your active income. Financial independence. Now, what is financial independence? Is financial independence means that your income is enough to support your expenses or a little bit of expenses and a savings? But no. What financial independence means that your passive income is well enough that it could take care of all of your expenses, or your passive income is more than your active income. Now, what does that mean? Active income is the money you're actually working for day and night. But passive income is a money which you invest and you forget about it and it grows on its own. So it's very important that the returns that you're generating from your investments could take care of your regular expenditures, so that you can just have your active income aside. And even in certain uncertain situations, you do not have to rely so much onto your active income. That is when you're financially independent. Portfolio diversification. As we discussed before, that's very important to have a diversification in your portfolio, wherein equity and debt both are holding some place into it, so that your portfolio is balanced and the risk associated with it can also be mitigated to certain extent. So it's very important while you make a financial plan, you make sure that certain portion of your portfolio always held by certain kind of debts instrument, so that you have fixed return and some reliability to go back to when market situations are not so great. Like today, that the market is in full swing and it's all about the market is actually crashing. At that time, having certain fixed income investment into your portfolio can be of great support and provide you the balance that you need. Now, in your financial planning, Prachay Bonds is great. Even the offerings are great. But how's the company performing? It's very important to know the company and its performance before investment. Now, the company is 8 years old, and in this 8 year, the company has not delayed on any of its liability. Also, none of its loan or any of its asset has been under loss. So there has been no single rupee loss for a single day. Plus, the AUM of the company has been growing steadily. If you look at the funding mix, then you will see over the years, the company's funding mix has been more drawn towards the investor side. As I said, that we are an investor centric NBFC, and along with the asset side, we are also providing wealth management options to our investors. So we have designed our business model in a way that we provide investors with better returns and make them a bigger part of our funding mix, that is a way through which we raise our funds. Return on equity, that is the returns that we are providing to our equity shareholders, has been always upward of 17% post tax. When I talk about return on my total assets, that is return on my assets on the loan book, in that case, it has been upward of 4%. When I talk about net interest margin, that is a spread or the margin of my interest rates, in that case, it has always been upward of 8%. This is how the company has been performing around this 8 years. What is the future plan of the company, or what are we supposed to do with this money that we are going to raise through this issue? The company plans to expand its operation to 15 other Tier 2 cities and provide financial solutions or financing options to more mid to large corporates. That is how the company plans to operate in the coming 5 years. That is it from my end. Thank you so much. Thank you all for being here. For any questions, you can contact us at 99218 00036. Thank you so much.